Good morning, United Kingdom. Everybody, good morning to a drive time session to 8 a.m. to 9 a.m. with Lakhi Singh, the property fixer, and the alternative business and property solutions community with Lakhi Singh, the property fixer. Morning, Lakhi Singh. How are you this morning?
I'm fantastic, thank you.
You sound good and you look good. Looking sharp as always.
Trying my best.
Trying your best, as you say, always prepared. What did you say? You're born ready. That's the one. You're a bit like what's his name? Matt Damon of the property world. You've got lots of different passports and different IDs, and you can run 5 kilometers in about 6 minutes. Yeah.
That'd be about right in property terms.
Yeah. Excellent.
Maybe not
right.
in physical terms.
Pardon?
Maybe not in physical terms, but definitely in property
volume
terms.
Issue, I think, or you put that? I think we had a problem with the volume. We can't hear you, sir. Get your volume up. Can you hear us now?
I can hear you fine.
Sounds better now, sir. Band sounds better. Sounds more like the Bourne ultimatum. Right, sir. Topic for this week. And the continued topic that we're going to be running is negative equity, which is obviously a serious topic. It's a hidden, it's a bit like, I think a lot of people were talking to someone yesterday and they said it's a bit like Jaws. You know, the Jaws movie I had when they said something lies beneath the sea or something, under the calm or something, and they got this woman's legs sort of like flipping around, and got the big shark at the bottom. I think that's what negative equity is, isn't it? Anything?
Yeah, I think it's that's probably a good analogy. It's basically just a matter of time before you get bitten if you don't get out of the water.
Yeah, it's like having a calm water on top, which is cash flow. Everyone's living it up, still living the lifestyle with the low interest rate cash flow. But under the water is the big shark of negative equity. And then Lakhi Singh has got his waxed legs swimming around the top, trying to tell people, look out, there's a shark, there's a negative equity shark. Look out, everybody, and no one's listening. And the ones who are listening, oh, yeah, but I didn't realize, but now I want the solution. But they're under that type of thing. And the other topic, or the saying of the week, as we've said already, is getting started is being ahead, which is basically like saying, stop procrastinating, get on with it. And I think Lakhi importantly brought out yesterday or day before yesterday is that getting started is a relative term. To one person, getting started may be starting the research. To another person, it literally may be putting the money on the table and buying their first business or their property. And talking about business and property, a lot of people I think are confused about the fact a property is a business. And I remember someone, I don't know who it was, long time ago, told me I treat each property as a business center. So basically said what I do is I take the property and I look at it as an individual P&L to work out, is this a profitable business or not? Is this a unit worth keeping or not? Is that the type of thing you've been doing, like you're saying, in your endeavors and successes?
I think done pretty much every type of approach to property, from the good, the bad, and the ugly. So I think I've learned my lessons from the past in terms of doing it the wrong way. Mm-hmm. So yes, I've actually done it the wrong way, where I haven't really kept tabs of many things. Mm-hmm. And then I've also done it the right way, where now obviously we're helping people with their problems. So you're really got to be on your game to be able to help mm-hmm. them with the best practice. Mm-hmm. So yes, just been quite comprehensive in terms of my understanding of all the right approaches and methodologies to get things out there, get them working.
So interesting. We were talking about being prepared. Talking about keeping your eye on the numbers. Talking about stress tests yesterday. A lot of buzzwords coming out, but then I think you said you have a unique property analyzer. It's a free tool you give to lots of people who just want to go through their property portfolio and realize where they are. Are they good, bad, or ugly, as you use this terminology? Bit more giving a person, people understanding of the overall scenario, not just one aspect, whether the cash flows are good or not, but saying you may have good cash flows, but ultimately you still are negatively geared. So where are you in the bigger picture? So I want to lead on for these questions, and I want to find out from you, Lakhi, what is it that makes people so engrossed with property as above beyond, whereas in normality, if it was a business like a restaurant or a corner shop or something, they would have thrown the keys in if it wasn't making financial sense. Why did they insist upon holding on to these assets, even though they know that they haven't got any equity in them? It's only the rent flows coming from them. And every day they hold on to them, they're compounding their losses. So what is it that keeps people attached with property, but doesn't? If it was a restaurant, like I said, it was a restaurant, a corner shop, or a fast food, or some laundry supply company, and it wasn't making money, that they would have quite easily just thrown the keys in. What's the difference? Why is there a big difference?
Well, I think it's just human nature is the issue. I think as humans, we want to get shelter. We want to be loved. We need to have food. So it's a sort of primal thing. I think a lot of people think that now they've got a property, they've got the shelter, and they extend that thinking to their business acumen and the way they approach business. So they are looking at the assets as something that's personal to them, and they're then emotionally getting attached to their assets, which is you could sort of say a rookie. It's a sort of American term, a rookie's mistake. So basically, you got to really be completely detached from your assets, and you got to be thinking them as a business venture. And if you don't, then you're going to be leaving yourself open to potentially coming back and biting you at a later date if you're not really thinking about them as in a detached way. So you used the word attachment earlier, just a second ago. So yeah. I think attachment and detachment are key. So it comes down to basic, your basic psychology around business and consumerism. So the more detached you are, less material you are, the less consumerist you are, the more able you're to look at things for what they really are, as opposed to getting engrossed in the quick fix or the money or the emotions around business, or property.
I think, okay, we've got morning. Sajil, she started to use the Lakhi Singh property figure. I reckon this is going to catch on throughout the whole of you. Lakhi Singh, the property fixer, she says, hi to everyone. Morning, Sajil. My favorite from the south of London, who obviously is probably pushing the buttons and doing her work as she listens to us. So the question is it not that people who are seen to have properties are seen to be successful, whereas you might have a restaurant and you may be making more money than you're making from properties, but a restaurant is not seen as being the status of success. It may be the fuel but the status of success is to have properties. I think isn't that one way of looking at it? That people look at individuals who've got a portfolio of properties as having been successful, even though they may not be making that money from the properties as much as they're making from restaurants. But if they've not configured the financial tools correctly, the image is correct, but the numbers say other. Isn't that another thing to do with it, Lucky? That
I think
having like this guy's made it.
Yeah, I think there's a cultural nuance to this, and also a societal sort of aspect to this, where a lot of people, like certain cultures, they want to be seen to be having the big thing. They want to show that they're keeping up with the Joneses, and that I think quite a lot of people, indirectly or directly, actually involved in that mentality. So if you're living in a little village, say, and everybody's got a 4x4, mums are driving 4x4s, and they're having coffees, and everybody's expected to be at a certain level. And then if you're if you're renting and you're living in a pokey one-bed flat or a studio, I think there's a lot of judgment that takes place in these sort of environments. A lot of communities, lots of cultures. They actually, if you've got like a nice car, or you've got a few houses or a big house, then you're judged about really how good you are. And I think that psychology overspills into how people actually carry out their business as well. And they want to be seen to be being successful, but 9 times out of 10, because their psychology is wrong in the first place, then they're already toxifying their business from day one.
Okay. Can I ask you now? Then now we've gone to the full circle of discussing psychologies, what negative equity is, who the Royal Institute of Chartered Surveyors are, how valuations go up and how they come down. If it is that the mortgagor, the person at the end of the chain, the bottom of that chain, for example, in the chain you've got the banks, the developers, the landlords, people that own the land or the assets that get developed. Then you have the subcontractors. Then you have the IFAs and the estate agents that sell the assets on. And then you have the bottom of the chain, the people who buy them. If that be the case, who's made money out of this whole mess then? Somebody surely has made some money, or has everybody lost?
I think the people that are the biggest benefactors for many of this are the banks, because the banks are 200-300-year sort of institutions which have derived a system that always puts them in a position of power and income generation. So in fact, their business model is probably the most effective, all in all, or has been anyway. But when they haven't succeeded also, they've also somewhat overstepped the mark and still try to get their way, even with a lot of negative equity properties from certain banks such as Mortgage Express. They still hold a something called an all monies charge on portfolios, and means that even if one of your properties is negative equity and you've got 2 others, what they do is they've actually take a charge across all 3 properties with the contract that they hold. So that means that if one's short, they can come back after all the others. So in my opinion, the
very
banks
draconian, I think I'd say, isn't it? Okay, this leads to another conversation then. Right, okay. We've got Carolyn Williams, as usual, very active, health instructor, first thing in the morning, giving us a big shout out and telling us the orange rule. Well, I believe she means eat an orange, or maybe orange is a nice color, or maybe I don't know what she means, and she'll probably come on next time again and tell us. The orange room. Anyhow, right. 3 or 4 questions coming out of what you've just said there. Number one, who is it who's made money? The banks. Okay, the banks always win. The banks are the ones who are too big to fail. That is really the heading. Okay. Now, if the banks are too big to fail and they've lent out to borrowers and they're too big to fail, what's happened with their negative equity then? They will have, let's suppose, example is they've got a £1 billion pound sterling loan book. So they've lent out to various customers £1 billion worth of mortgage lending. Now, if the client, the very bottom of the chain, a borrower, is getting penalized for the negative equity, what happens? What does the bank do then? Where does their negative equity go? They've lost £500 million, suppose.
Well,
So they've had £500 million written off their loan book. Now, the assets they have on their mortgage loan book is only now worth £500 million. What happens with them? Who
let me get back to the basics of this. So the way the banks operate is like extremely sophisticated, and I think the normal day-to-day business person or a 9-to-5er can no way comprehend really the level of sophistication they have in their systems. So they apply something called actuarial science to their processes. So these are specialist people paid, hundreds of thousands of pounds that look at the processes behind actually ensuring that whatever happens, then they don't lose out. So they've got every single thing covered over 2 or 3 times. So even if they lose, they still make double. So this is actually
science. Is that actually
yeah.
a word?
I made that up. I made that up, but actuaries are specialists in looking at risk and
are these the kind of people who look 30, 40, 50, 60 years ahead and see what they predict is going to happen in the market, and then they offset and they derive. So the purpose of an actuary is to create derivatives, and the derivatives are the benchmarks that are used in the market that determine what they predict is going to happen to the market, which determines the way money is moved around in the market. So what you're saying is the way they structure everything is they always win. Is that what you're saying?
That's right. So they pay literally hundreds of millions of pounds for specialist advice to ensure that when they're rolling out billions of pounds of funding to at retail level or investment level, that there's not even like a 0.1% of a potential kink in their armor.
Okay, so let me get this right. So you're saying actuaries write contracts, write the risk, predict the future, determine derivatives. And remember, a lot of people may not know what derivatives are, but they're the principal points under which something is mitigated or understood in the financial markets. So derivatives, complicated formulas. They are those people who could derive the derivatives or the formulas for the derivation of values and losses and all that. And you're saying that in all circumstances, the banks always win, the borrower always loses. So in this matter, with a loss of let's keep to the example, £500 million has been written off the property, their mortgage books. How do they make money off a loss of £500 million?
So there's a couple of key words that come into play, and I think it's important that we understand the definition of those words. I am not necessarily an expert in this area, but because we've been doing hundreds and thousands of negotiations with banks. We've learned a lot through getting barrister opinion and also getting a more technical understanding of really what they do. So one word is loss adjustment. Another word is debt provisioning. And
Very clever, Mr. Singh. Debt provisioning. And what was the other one? Loss adjustment.
That's right.
Right. Is that the type of thing you do when you've got your underpants on and you're not quite put them up properly and you need to just fix everything to make sure it's loose?
I would say something quite similar that the banks do. That's right. It's
okay.
Anyway but loose.
Yeah.
So they keep a tight grip.
Like that, yes.
Tight grip on their faculties to make sure
on
that
everything, yeah.
They basically
loss adjustment.
Yeah.
Loss adjustment, debt provisioning, and then what else? These are two.
Then it's a debt write-off.
Very nice, debt write-off. I like that.
So debt write-off is more what we do as a solution. But let's say what happens with banks is technically they never lose. So even if you had £500 million of losses, they've actually insured themselves. So there's two things that come to mind which are critical to this discussion. Number one is that they'll never lose because they've insured themselves against losses. So even if you sell, if they sell your, if I'll give you an example, somebody bought a property for 500,000, the debt was 450, the bank's now sold it for 300, say. So the loss is 150. Now, is the bank going to bear that loss? No, they're insured against that loss. So that's critical point number one. Critical point number two, this is actually the scary part, and nobody's really going to believe this. But what happens is, not only do are they insured, they also can come after you for the 150, even though they're insured for it anyway.
They can come after you for the. Okay, can I get that right? So they're chasing you for 150,000, even though they've got insurance to cover the loss.
That's right.
So that's money. Is that the reason why these big banks normally recover in sort of like 6 months with profits of billions of pounds? It's not really profits. They've actually written off the loss. They've been paid out on insurance or on the difference of the payout, i.e. the recovery was 300,000, there's 150,000 shortfall. They've got the 150. And what they're doing then is they're actually chasing clients for the cream, which has got nothing to do with the debt.
Yeah, I mean, it sounds damning. And the funny thing, it is damning. And we just got to be careful that because we're bringing out the truth about what the banks are really doing, they don't really want anybody to know. And because we do this on a day-to-day basis, we know the reality, what happens behind the scenes. So nobody, I think hardly anybody that I've ever come across, maybe 1 in 1,000 people, maybe a couple of barristers, or maybe some claims companies that specialize in debt write-off, are the only ones pretty much that I've had a conversation with that have understood really what happens in this process.
Okay, so Lakhi Singh obviously is just as shocked as I am with these revelations, and he says, oh my God. So he's obviously shocked. I think it's quite disbelieving. So what you're saying is banks never lose. I can understand that. So they've got accountants, just like any business, sitting in their back office and saying, right, there's been a provisioning, as you use that word, debt provisioning. Is that the one?
That's the one, yes.
So they've said the market's crashed. We've got the right now to provision for losses, like any business would do. So they've said 1 billion now is only worth $500 million. Understood. So that $500 million, even though they've provisioned for it, and it should be regarded as a loss that gets taken across for purposes of tax mitigation, what you're saying is the insurance covers them for the loss. So they get the 1 billion back technically. So let's say it's not exactly 1 billion, $500 million. It may be 300 million, let's suppose, or 350 million. But the bottom line is they are still chasing all of these clients, all these borrowers out there who've let go of their properties for the $500 million that's been lost. And whatever they make on top is cream on the cake, which goes into their profit sheets, which is why a lot of these banks end up in profit very quickly, showing profits of billions of pounds. Is that what you're saying, Lakhi?
That's absolutely correct. And I think this is actually touching the surface of the level of exploitation that the banks can carry out without them actually being found out, or without actually being made open to the public. So I can give you even worse situations where the banks are doing things behind the scenes, which are even more untoward. I mean, I have to be careful because having met with so many bank directors over the last 15 years, there's a lot of, sort of sensitivity in terms of what they want to give out and what they want to keep to themselves.
So your
but a lot
story
of the
is
things
a bit
that I've
like
found
Jason
out,
Bourne then. You are a bit like
right.
the Jason Bourne of debt management.
That's right. A lot of things I've found out, they won't necessarily want us to disclose, but they're things which made we found out by just being in negotiations with them about what they really do. So I've got tons of case studies and stories of things that have happened where they've literally pulled the wool over clients' eyes. I mean, I can give 2 or 3 quick examples. When using all money's charges, they, even though the clients actually paid them back all the money that they owed to get their properties back, they've still kept the properties and then sold them at a loss for the client. So there's hundreds of those sort of cases that we've seen over the last 14 years.
Fact that comes out of that.
Yeah.
I read somewhere in some of your meetings, you discovered the fact that a mortgage account, so a mortgage contract, is an individual contract. So each mortgage account and contract is separate and it can't be regarded as being one of a whole. So if you've got 5 mortgage accounts or 5 mortgages with the same lender, technically the all monies charge can't be applied because each mortgage account is separate. So if a property was sold and it did have equity in it, technically they can't really take that money but without your consent. And a lot of people were fooled into, actually coaxed into, or fooled into believing that they had to give the permission because that money was the bank's. Is that what's been happening?
Yeah, I think there's a huge number of cases like that, and so we're in a position technically, if we wanted to do all like a class action against some of the banks for actually carrying out a lot of these malpractices, we would be in quite a strong position to do so. I think a few people have done that. For example, West Bromwich Bank, I think, got taken to court by about 50 individuals because they were charging a higher interest rate when the rate was actually a lot lower, and so they're charging maybe 5% when they're meant to be charging 3%. So there's been lots of cases where there's a lot of malpractice behind the scenes. That's just one of them. And there's another one where one of the techniques they use is even though you've got a contract that you signed with them officially saying these are the terms and conditions with the bank, so everybody knows what they're signing. We've had cases where we've been to see the bank with the client, with their portfolio, and the bank has said, actually, the contract says this, and you haven't complied to it. But when we look to the contract, whatever they're saying is not in the contract. This is an internal document that they have, which is a list of additional contract points that they've got internally, but they haven't stipulated to the clients or the solicitors.
Wow.
Now that's, if you think, And I
Okay.
think that was a case that we did with the client about 10 years ago.
Mhm.
And literally, I'm sort of, we're sort of gobsmacked really about what the banks were getting away with.
Is it really? Is it okay? Let's try and understand. A question that we've got. Hang on, before we go to the next level of thought and discussion on this, we've got Karen Williams, obviously, who says my backdrop keeps changing. I think she's probably referring to the fact it seems that I'm more at the London Palladium, I think, than being in the studio. Thank you very much. Obviously, we are here to please. Hope you're pleased, Carolyn. The second bit is Zishan asking a question to you, Lucky, I think. What is a mortgage prisoner? What does that mean? Because we talk about contracts and the clauses in the contract and the fact they're saying things which are not there. He's saying, what is a mortgage prisoner?
Okay, mortgage prisoner is a term that's actually, I would say it's not really well known in the current property market or the economy, because it's a phenomenon that I think that's going to be probably a sign of the times, an overspill of COVID-19 and Brexit. Basically means, I'll give an example, it's easier to explain. Somebody's bought a property, say 20 years ago. Let's keep it simple. Let's just say it's a residential property they bought for 500,000, and they bought it on let's say they're paying interest-only payments, not repayments. And they bought the property, so let's say for 500,000, and let's just say the mortgage is 450. And because they bought it, they're not doing any repayments at all, and 450 is the debt or the mortgage that they're paying towards every month. Let's just say 20 years have passed now, they get a letter to the post and the bank saying end of terms come up. So they go out to the market, they speak to a couple of brokers, they speak to the mortgage broker, they speak to us, whoever. They say, all right, I need to actually get into a new mortgage now. What do I do? So their circumstances may have changed, so they may not be on the same income. So before, maybe there's a very good income multiple, so they could achieve 450 debt. Now, because their income is lower, that's a very simple example. Somebody's only on about 50,000 now. They may have been on 100,000 before. Now, the question is, they can't get out of that mortgage into a new lender, and they're stuck. So the only way they can get out of that easily is possibly by selling the property, or possibly maybe speaking to a relative or a friend and say, look, can you join me on this mortgage with your income to make up the multiple? Now, those things aren't easy, because how are you going to find somebody to come and join you on your mortgage?
Exactly.
There's probably, you have to speak to maybe 100 people, and maybe if you're very, very lucky, your parents or a loved one may want to assist you.
You are very, very lucky. You are the lucky.
Exactly. So my point is, being a mortgage prisoner is where you can't get out of your current finance arrangement, and you're trying to find a new way of getting out there, or a clever way of getting out of it into a new product, but you can't because you're stuck. So that's just an example for a householder who's stuck because they can't get the multiples because of their income. Now, it gets even worse when you look at investment property, actually, which is that there's just to give you a slightly quick example, same example, £500,000 buy-to-let property. This time round, let's just say you manage to get, let's keep it simple, let's just say 425,000. And after 20 years, you're still an interest-only mortgage, so you haven't paid any capital down payments to actually pay it down. So let's say you're on 425, but now let's say you're at the end of term and the mortgage company is saying you need to get a new product because the terms come up. So you go out to the market again, but this is where it gets really nasty. The loan to values now that are being lent on by to let lenders are 75% as an average. Now, what's worst is that Bob Singh just put out an article, I think yesterday, and I sort of made mention of it, is that they're actually making it difficult for you to even get 75% because they're literally pushing down to 65% now. But when the values are also going in, they may value the properties down. But what the banks are doing, they're finding any reason not to lend to you as well. So question is, if you look at it financially, let's look at the numbers. Let's not worry about the emotions or what it all is. What are the chances that you're going to be able to get out of this without putting any equity into the property? So all of a sudden, you have to beg, borrow from family, friends, maybe try to raise their equity because you're going to be short, because 75% of 500k, I think, works out to 375. So you're going to be short by 50k straight away. Then if you're only getting 65%, you might need to get another 10%, which is going to erode your equity further. So you're going to need at least about 100k. And if the value is going and they value the property down, then what you're going to do? So, and if you're now look at your income. Let's say if your income is lower than when you bought the property, and you haven't got any equity, and you haven't got anybody that can come in to actually support you in structuring this, you're going to have to sell this asset. And if the property prices have also fallen in 12 months from now, because the market, we're in a recession, it's a slightly depressive market, then you're in a situation where all your equity is going to be eroded. Plus, you're going to have to sell to get out of this. And can you imagine the amount of people that are going to be stuck in this particular hole? And I think there's a stat, I think that there may be between 6 to 8 million people plus that are going to be in this particular predicament. So I am like really worried about thousands of people out there who haven't really thought of the implications of really what's going to be around the corner. They're living day to day, living month to month. Yeah.
Okay, Gurmal Singh says good content. So obviously this topic is very interesting. It's disturbing, but it's interesting. It goes to the heart of where we're at, what's happening. You mentioned something, and I think you mentioned it quite slightly, but I think it is the underbelly, you could say, of the problem. And that is a lot of the properties that were being taken out in the past 10, 20 years have been on this interest rate only. So there's two parts to that. So the same point that Ninda brought out last week, that interest rates will stay low because they're keeping their eye on inflation. But effectively, a lot of the products that came into the market once this big boom in the early 2000s was going on were interest rate only products. So you were basically paying a small amount because the interest rates were very low on a large sum of money. So you could pick up a £500,000 pad, or a numerous 3 or 4 properties that would total up to about £500,000 to £1 million. And really, you were hardly paying any money against them. And the yield against the cost of that loan was higher. So the attraction is you can buy not one, but buy 2 or 3 for the price, still service all that debt, collect good rentals, and yet in reality, you've spent 5, 10, 15 years not even having to have paid off even 2 or 3% of that debt. Whereas in the old days, if I'm not wrong, and you can put me wise to this because that's probably more relevant to the time that you were alive or in property, and that is repayment mortgages. Wasn't that something that our parents were more interested in, paying down the debt? So by the time it came to redemption, they'd have a small amount of money to pay off, even though they weren't making a lot of money from their rental incomes, but they were more interested in paying the debt down, so trying to pay the bank back over the period rather than trying to just collect money and rentals to spend. Doesn't this go back to that word we used about 3-4 weeks ago, consumerism or consume, or in Latin as it means the devil, that who is to consume? And doesn't it go back to the fact that people were buying properties not for the purpose of realizing asset and collateral, but more for servicing their lifestyles? Wasn't that the way it was being pitched? And a lot of these off-plan properties were being sold, and no money down deals were being done. And all of these products, basically, I mean, 90% of these products were all interest-based only. What do you have to say to that, Lakhi? Wasn't the old formula better? Buy a property, pay the debt down, try and pay down as much as you can, so that by the time the loan or the product ended, you had a few £1,000s to pay off, and you had an asset that you owned cash outright. Isn't that the way it should have been done? Isn't that another compound to the problem?
Yeah. Well, I've got a few points about that. I think the way the psychology or the foundation of society's changed is possibly the route that's actually allowed all this to overspill into consumerism. So I think in the 80s and 90s, in the Thatcher years, you had the sort of yuppie era, and everybody wanted to get a nice, new car. They all wanted holidays. So everybody, the working class became middle class. The middle class became upper class. It's that sort of keeping up the Joneses psychologies, which is what we started off with the conversation with. I think
more
that's
money, more problems. Yeah,
that's right. So I think the immediate gratification of holidays and that psychology around money, consumerism, that's actually probably led to actually this type of psychology around business as well, which is gearing, probably on working beyond your means, and not necessarily being a business person, but looking at the lifestyle, looking at the benefits rather than putting in all the right fundamentals to actually protect your business.
Yeah.
So unfortunately, that's where the culture of materialism has probably led to a lot of exuberance. And now I think anybody that's overgeared or got too much debt because the banks were giving it out readily and willingly. So what they were giving out easily, now they're taking away, or in the pipeline of taking a lot of products and services away. I mean, if you go to the high street now, you'd be lucky if you're getting 65% loan to value and a lot of buy to lets. You're lucky if you can actually even open up a business bank account now, because the banks aren't opening up business bank accounts because of COVID-19, which is ridiculous. So there's literally, in some ways, we're still, let's just say, hopefully we're at the end of the pandemic. But if this is actually just the beginning of the pandemic, where is this all going to go?
Don't say that, Lakhi. I'm having stomach cramps. So, God forbid, this is the beginning, not the end. What happens then? They've already gone to point zero. There's nothing happening. Everything is stuck. No lending, no banks processing, no business accounts. Ninda said the other day, all the big the chains, high street retailers are going into CVAs so they can renege on agreements, they can reduce on rental and rates, they can downsize their cost of payment of staff. Basically, if that's where we are, what's going to happen next? Where do we go?
Well, I think going back to practicality, one of the things we discussed, we don't really want to scare people out of their wits about what's really happening, so that they stick their head in the sand. I think the first thing is that you've got to keep a positive outlook. It doesn't mean that you keep bury your head in the sand about what the likely changes in the market are and flux. I think the biggest issues for a lot of people is going to be is that it's human nature not to accept change. So anybody that's willing to look at things afresh now and look at what's really going on, they're going to be the benefactors of being hugely successful in this market. So if you've still got the same demeanor of positivity and let's say a growth mindset that you had a year ago, and you can still apply it in this market without getting trapped with your emotions, and actually look at things as for what they are, then the likelihood is that whatever's going to happen, you're going to be able to look at it practically and then get not sucked into a distress situation, because technically you're causing the distress just by your psychological outlook. So that would be my fundamental point of the day, or of the year. I would say that you're really going to be clear about your psychology around debt.
Okay, interesting.
And what's happening in the economy, and not really
interesting
take
point.
it.
Interesting point come from Daljeet. He said, look, if there's no money being generated from interest, so the interest in the market, i.e. banks, retailers, high street shops, businesses, whatever. Basically what he's saying is they're going to start raising money from taxes. How does anybody pay more tax when they don't have that income? Or is it all this money that's come through from bounce back loans? They're going to claw that money back. How does that work? So we're talking about something new now that's come up, bounce back loans. What is the purpose of a bounce back loan? How is the government going to handle them? If there's no business,
Basically,
giving you a bounce back loan, how does that help?
Bounce back loan is just hardly different from quantitative easing. It's just that they're given money to people to keep them afloat artificially. So, I mean,
quantitative easing, what does that mean, Lakhi? You need to explain it, because maybe a lot of our listeners don't have the knowledge you do. They won't understand quantitative easing. Is that like Quality Street, but without the sweetness?
So, quantity easing is where the government's pumping in billions of pounds into the economy and flooding it with more cash to invigorate the economy. So this is by giving people direct access to funds for their businesses. It just means that they're circulating more money into the economy to keep it afloat. But that's only a temporary solution, because as soon as the bounce back runs out, because let's say the bounce back money will probably be spent by those businesses or used for their cash flows. It's only got a finite time depending on the type of business. So it's going to run out after 3 months, 6 months, or a year. So you're not going to, after that, it's going to be.
What are the terms?
When you say bounce back loan.
How do you get these bounce back loans?
The bounce back, the ball is going to be deflated. The ball will be deflated.
Sorry, I don't
so the ball will be deflated from the bounce back.
Yeah, but what I'm saying,
and then you're going to have a flat bounce. You're not going to. It's going to be literally not going to be able to bounce again for a while. Yeah.
Okay. The question is, a lot of people out there who are listening to you, they may not know what a bounce back is, and you may be doing a service by telling them they can have access to these bounce backs. So what does that mean? What are the terms of a bounce back? What does it go? It just gives you money for free? How much money can they take? What happens?
So a bounce back loan is actually, my screen seems to be frozen. Just wanted to check that everything's working okay on your side.
Yeah, we can hear you.
Okay, you can see me okay. All right, so bounce back, it's quite simple. It's a business loan that's given to businesses that have been open before the 25th of March 2020.
Mm-hmm.
And they're giving you 25%, whatever your turnover is. If you're turning over plus of £200,000, the maximum loan then you can get on that is £50,000. And if you are impacted by COVID-19 and your business wasn't able to operate between the months of March, April, May, June, July, say, then what they will do is they will give you the loan £50,000 interest-free for 1 year.
Excellent.
And basically, there's certain banks that will do it. So I think there's about 18 to 20 banks, mostly the main high street banks, and
that will process them.
That will process them, but they're making the process fairly difficult now. So we've had quite a few people come to us and ask us about the process, about how it can work. So we've got a lot of expertise and understanding, really raising funds, not just for bounce backs, but for business loans or bridging.
Another key tip there from Lakhi Singh, as he always does, subtly throws in a very important tip, and that is Lakhi Singh to be contacted on the alternative business and property solutions community if you're looking to get access to a bounce back loan or to understand it in more detail. And you can, what's the maximum money you can take out on a bounce back, Lakhi?
The maximum you can take out is £50,000.
Right.
But there are a lot more schemes the government's launching where they are throwing money into something called a Kickstart program as well now, where they will also help your business to get somebody to come and work for you for 6 months with no pay, but they will pay them.
Excellent.
But you won't have to pay for those resources. So there's that. Then there's the furlough scheme, where the government's paying 80% of people's wages.
Excellent.
If they're actually because of COVID, a lot of employers are taking advantage of that. So I think there's also something called CBILS, CBILS, which is another type of business loan. Which
is that a bit like Nibbles but without the salt in it?
Yeah. So there's sort of there's about 4 or 5 specialist type loans for startup companies, companies that are looking for investment, and the government will help to try and create a benefit for the investor. And then there's other loans for development projects. So there's a whole host of things, but I think let's just go back to the bounce backs. I think let's move on to the bounce back topic. Okay.
So the bounce back, we've understood. It's something there available. It's getting a bit more restrictive in how they give it. But yes, Lakhi Singh is a man to go to if you want to understand how to get a bounce back, whether you're eligible and how much you can take. Is that right, Lakhi Singh?
Yeah, I'm happy to help and assist in that process, yeah.
So we know now, if you really look at the overall scenario, negative equity, we're going back to the example we started off with, it's a bit like Jaws, isn't it? The shark at the bottom of the sea of calm with your legs, waxed legs, sort of swimming across. And you've got this big shark at the bottom, which is called negative equity, ready to pounce out as soon as the interest rates go up to literally vacuum up the entire economy. And because these products that have been thrown out for the last 20 years are all interest rate only, low interest rate or fixed interest, well, not fixed interest, but variable interest rates, which obviously benefit and people wanting to get maximized cash flow, but it doesn't really help you when you're trying to pay the loan down. Is there anything out there, Lakhi, that allows you to change your SVR, they call them standard variable rate mortgages, into fixed rates or something else, or a repayment mortgage? Can we still do that? You know, we were talking about the jump off point, or keeping our eye on the numbers and sort of like doing stress tests. What is the thing that we do? What's the juncture that when we get to that point where we've kept our eyes on numbers, and right now it's red zone time, we've got to do something. What type of solutions are available? Do you know what those are?
So there's a whole host of solutions. So just to keep it really simple for anybody who's sort of listening to the conversation at a very high level, let's just say you've got a house that you live in and you've got quite a big mortgage, and you're sort of thinking, okay, well, this Lakhi Singh guy, what's he talking about? Should I really be worried? Am I going to become a mortgage prisoner? So what I suggest you do is just talk to us, and we've got the community there. If you want to put up an anonymous question into the community to say, this is my situation, what do you think we should do? If you just send it to the moderators, they'll put it up as anonymous, and then we can give you feedback ourselves. But so that's one way. The second thing you can do is if you've got a property and you've got good income, everything's fine, you're not a mortgage prisoner, but you're thinking, okay, well, if interest rates do go up to, let's just say, 5% on your residential house, how would you get out of that problem? You know, how would you deal with it? So my best suggestion is to do a stress test, even on your personal finances, because a lot of people out there, you know, because we're trying to not just talk to investors, we're trying to talk to the average person with this house who's basically just trying to get by in a furlough type situation, maybe. What I'd suggest to them is that they review their mortgage, and possibly if they can show the right information to their broker or to the bank to try and put themselves in a 5 or 10 year fixed, then and even though it might cost a bit more and might make things a bit tight, because the SVR might be quite low at 0%, and you know, you're paying a couple of percent.
That's it. Really,
that's actually a false economy. You know that. So my biggest concern, and for anybody out there, householder, is what if interest rates shot up to, you know, you've got to pay 3%, or you've got to pay 4% or 5%. What point is it going to be painful for you? And if you want to avoid that pain, and you're not feeling the pain now, but if you leave it for a year, you may not be able to be in a position to be able to go on to a fixed rate. So you're better to put it into fixed rate now while the rates are good. So I would actually look to go into a fixed rate, even if it's 3 or 4%, and it's not too painful for you. So that would be my best advice. Otherwise, what will happen is when the interest rates do go up, you're going to be caught in a very difficult position. You're not going to be able to sell easily as well, because there won't be that many buyers out there, because they will be in the same predicament as yourselves.
Exactly. Okay, we're going to leave you with that note. Tomorrow we have our VVIP, Ninda Singh Johal, who's going to be on with us again from last Friday. I think we're going to start off tomorrow's conversation with stress tests. How do you do those? And what's the jump off point? Where do you decide, right, this is a time I'm going to take those actions? And we're going to ask Ninda if he has any solutions that could be applied when the stress test tells you now is the time to bail out, now is the time to get out. So thank you so much, Lakhi Singh, for coming again with us. Lakhi Singh, the property fixer, and with the alternative business and property solutions. Tomorrow, as I said, we have the VVIP, Mr. Ninda Singh Johal, who's going to be joining us as last week, because we had a lot of interesting conversation going on with him. And I felt there was so much knowledge there. And one drive time was injustice. So we're going to have him on tomorrow. Lakhi Singh, thank you very much for your time. Anything you want to do as a shout out last to everyone listening regarding the topic this week and the fact that the earlier, the sooner you get in, so you get ahead. That's the word. Being ahead is starting. It's taking that move forward to start doing what you need to do in terms of business and action. So anything you got to say before we go?
Yeah,
Yes?
I'd say starting is by listening to our 8 to 9 drive times, because it will help you to just reconfigure in your head really what are the key things you need to be thinking about. And starting is also joining the community, sending the message out to other people, and making a contribution to the community. If you've got anything that you think may be useful to our massively growing group now, which is plus of, I think, 600 now. It only started, I think, 7-8 weeks ago. So become a contributor, take action, and be supportive of others. And you'll find that you're going to get a lot more solutions coming back to yourselves by being part of our community. Okay.
And this is from Sonia as well, Lakhi Singh. And goodbye to everyone. See you tomorrow, 8 a.m. to 9 a.m.